Welcome to the Real Estate Guys radio show. There's a lot to look forward to and to be aware of in the coming year. And today it's part 2 of our predictions panel. More experts, more opinions, and more great food for thought for 2018. Today on the Real Estate Guys radio program. All aboard! Registration is now open for the Real Estate Guys 16th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, international developer Beth Clifford, the authors of Prosper, Chris Martenson and Adam Taggart, and the author of The Creature from Jekyll Island, G. Edward Griffin. And joining us live and in person for his 6th Investor Summit, Peter Schiff. And lots more to be announced. It all begins April 6, 2018 in Fort Lauderdale. Visit realestateguysradio.com and click the tab that says Summit to learn more and reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 16th Annual Investors Summit at Sea. Don't miss the boat. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. With me, as usual, financial strategist, co-host Russell Gray.
Hey, Robert.
Tons of great feedback on last week's show, which was our predictions panel part 1. Today, predictions panel part 2. We've got 3 amazing guests, 2 of them named Duncan, and you're going to learn a ton, so open up your ears and be ready for a roller coaster ride of facts, opinions, and the future on today's Real Estate Guys radio program.
Hi, this is Kevin Harrington, original shark from the hit TV show Shark Tank, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com. It's the beginning of a new year. We're here in the middle of January looking at what may happen in 2018, and very pleased to have with us Dr. Doug Duncan, who is the Senior Vice President and Chief Economist for Fannie Mae. Hey, Doug, welcome to the program.
Good morning. Thanks for inviting me.
Well, absolutely. We were thrilled to have you speak at our Investor Summit last year, and one of the things you talked about then was kind of where we were in the cycle, and of course, everyone's interested in that. At the time, of course, it was April of 2017, and your remarks include the fact that we were pretty long in the tooth in this cycle. What are your thoughts now? What does it look like from where you sit?
Well, that's certainly all still true. We haven't tipped over into recession, and the recent data don't suggest a recession is in the offing, say within the next 12 months at least. Plus, we have the benefits of some tax reform that will support the extension of this expansion, but it doesn't change the fact that from an historic perspective, this is a pretty long expansion. Even if you're not expecting a downturn, it's useful to have in the back of your mind, what kind of risk management am I undertaking to make sure that I are mindful that at some point every expansion has ended. Our thought on 2018 is there's a bit of a battle that's going to take place between the combined forces of deregulation or reduced regulation plus the tax change against the global central bank decisions about what to do in monetary policy now that the entire globe is modestly expanding together. And I think those two forces are going to compete with one another. Our belief is that in 2018 we will actually see a little acceleration of growth in the full year over what we saw in 2017. We've added about a 0.5 percentage point to our previous forecast as a result of what's happened within the last couple of months. So that means we think that the economy will probably grow somewhere around 2.75% this year. A little bit of that will carry over into 19, and then things will slow down.
Okay, good stuff. Well, of course, our listener base, primarily real estate investors, and what listeners may not know is that before you served at Fannie Mae, you were chief economist at the Mortgage Bankers Association. So let's talk about the lending side of things. Listeners want to know what's going to happen, of course, to lending so they can make decisions, and nobody knows for sure. But thinking about folks that maybe have some property, looking to acquire some more, what do you see in the lending world for this year?
Sure. A couple things. Let's talk about interest rates in the background. Then we'll talk about supply and demand characteristics and what we think that might imply for price. The comment that I made about global central banks and the battle with fiscal policy suggests that the central banks are going to tighten, which would imply upward pressure on mortgage interest rates. Certainly the U.S. Fed is running off its portfolio of mortgage-backed securities. Over time, we would expect that would push rates up, although we don't expect a lot of movement upward this year, depending on what happens with, for example, the ECB. If they also taper, that will put a little more upward pressure. So what about the demand side of the housing market? There's clear evidence now that the millennials are moving to buy homes as opposed to rent 300 square foot apartments downtown. So the demand side of the housing market is strong. It's shifting the balance toward owning, but there are so many millennials that doesn't mean renting properties won't be a good place to be. I do think that while you'll see the large multifamily component of the rental space slow down, and that's already underway, that's primarily because in the largest metro areas, the highest quality component of the multifamily is probably saturated for the near term, say the next year to two, after which you might see a little more pickup in building. But that part's going to slow down. So we've balanced over to the buying rather than renting, particularly in those big multi-unit properties. Well, what about the supply side of the equation? Well, I mentioned the supply of high-quality apartment buildings is probably up to the need, but that's not the case on single-family homes. The supply of single-family home construction is still running slower than the demand for single-family homes, whether it comes from investors or from owner-occupants. And so I think you'll see the continued gradual growth in the supply side of the market, but not fast enough to meet the growth in demand, which means that real prices are going to continue to accelerate faster than has historically been the case. That can't go on forever, and so the question is, will income growth catch up to price growth and help to stabilize the balance between supply and demand? The answer is that the tax change should result in household income growth, as most people will actually get a tax cut. All the noise, political noise around this has really disguised the fact that, in fact, most households will receive a tax cut, and if the business part of the tax code works properly, you should see an acceleration in business investment, which would lead to an improvement in productivity, which would lead to a growth in wages. So some of that, if that all operates normally, will lead to income growth, which will support the ability of households who want to buy to make the purchase, even in the presence of strong price growth. So that's kind of how we see the big picture in that space. Obviously, there are regional variations on this, depending on where job growth and income growth are taking place.
You know, Doug, when we last spoke, kind of the theme of your talk at the summit in 2017 was what change would policy have, and at that time you talked about personal tax and what the change might be, and corporate tax, and some other things as well. And as we get further into this presidency and we see what's happening there, and of course moves by the Fed, what is it that you're keeping your eye on?
Yeah, I think our theme was, will policy change extend the expansion? And then, of course, across the course of the year, as the policy was being debated, we said, well, maybe we should have shortened that to just saying, will policy change?
Right.
And in fact, very late in the day, policy did change. That is particularly fiscal policy, and that was the advent of the tax cut. I think the discussion in 2018 in terms of fiscal policy is going to be over infrastructure spending. Both parties see some value in infrastructure spending, but whether they can come to an agreement on how to do it is an open question. from an economist perspective, the infrastructure spend is more about economic efficiency than it is about stimulus. And I would agree there is a need for infrastructure spending. We should be expanding airports, improving highways and bridges, those kinds of things. But it's more of an economic efficiency thing rather than a stimulus. There will also be policy change in the Fed. That, first of all, we'll see a transition in leadership from Janet Yellen to Jay Powell. There's been a lot of speculation in the press about Powell being a dove, much in the manner of Yellen. I don't actually personally believe that. I think he's quite a different person. I think he's going to manage the transition so that markets don't get any shocks in the course of the transition, but I think by mid-year we will start to see some imprint of his personal view on things, which comes more from a corporate finance and an industrial perspective than it does from a pure macroeconomic theory perspective. So I think we'll start to see the emergence of a different monetary policy strategy. Whether that involves an acceleration in the reduction of the Fed's balance sheet will be a really important question for where interest rates are expected to go. Our view is right now, based on what we know, we have incorporated into our forecast the Fed making 2 increases in the Fed funds target rate over the course of the year, which is roughly where the market is. The market's expectation is about 2.5, which doesn't make a lot of sense because you can't really do half a move.
Right.
The Fed themselves, the various governors on balance, have suggested 4 moves. It's not clear to me that in the presence of running off their portfolio, which is a tightening itself, that the Fed is likely to do 4 moves. So we've stuck with a 2-move view. That will, of course, depend on whether this acceleration of growth that we're seeing domestically and globally leads to inflation pressures or whether it leads to income growth because of pickup in the business sector, which is non-inflationary. That's a really key question for where rates are going to go.
Obviously, rates are going to impact investors a ton, but also availability of financing. And of course, at Fannie Mae, you sit in a position to see a ton of that. But I think I saw an article in December where you were quoted talking about competition of lenders, and that's an interesting thing to talk about. Is there's more and more need for the placement of these loans. Where do you see that shaking out? Are we going to see a change in who's providing these kinds of funds, especially, as you mentioned, since it's single-family homes where there seems to be continued demand?
Yeah, there's always a component of competition in the single-family lending space, which is driven by the balance between refinancing and the issuance of mortgage for the purchase of a home. Yep. And with an upward bias on rates, you would expect the level of refinance activity to slow down, and that certainly is the case in our forecast. That leads to more intense competitive pressure for the loans to people who want to buy a home. It's often the case that refinancing activity falls faster than home purchase lending activity picks up, and so then you see the shrinkage of profit margins and you start to see mergers and industry exits. That's underway today, and the lenders themselves, who we survey on a quarterly basis, are saying that the biggest challenge they have in the market today is competition from other lenders. So that drop-off in refinancing, even with this modest uptick in interest rates, which to this point has been very modest, has led to those increased competitive pressures, and you are starting to see some firms leave the industry. We would expect that to continue over the next couple of years, but the barriers to entry in the mortgage lending business are relatively low, and so this is not an unusual cyclical kind of behavior.
There's Dr. Doug Duncan. He is the Senior Vice President and Chief Economist for Fannie Mae. Doug, we always appreciate your insight. Thanks for your forecast, and we'll look forward to seeing you soon.
Great, my pleasure. Thank you.
You're tuned to the Real Estate Guys radio program. More from our predictions panel when we come back. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
This portion of the Real Estate Guys radio program is brought to you by International Coffee Farms, where you can own a parcel of land in your very own specialty coffee farm in Panama for as little as $15,000. Here's how it works. Deeded half-acre parcels entitled Specialty Coffee Farms in Boquete, Panama are turnkey managed professionally on your behalf by a team of local experts. Sustainable average income is estimated at 12%, and cash flow can begin within 12 to 15 months from the date of your parcel ownership. International Coffee Farms' mission is to own and operate specialty coffee farms that are economically, environmentally, and socially sustainable. As part of this mission, 20% of the gross profits of each farm is committed to a socially sustainable fund to improve the lives of the Panamanian coffee farm workers and their families. International Coffee Farms currently owns and operates 9 specialty coffee farms with half-acre parcels available for immediate ownership. To find out how you can become a coffee farm owner in Boquete, Panama, email coffee@realestateguysradio.com. That's coffee@realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Peter Schiff, and you are listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program, starting out a brand new year and trying to figure out what's going on. It's our prediction show, and the gentleman you're about to meet is an economist that has written an amazing book, couple of books actually, but the book that's been sitting on my shelf for many years and I pull it down from time to time is called The Dollar Crisis. And I think Richard, you were the first one to really turn us on to some of the nuances of fiat money and all that. But let's say hello to Richard Duncan. How are you?
Robert, hi. Thank you. I'm very well. Thanks for having me back on the program.
Well, it's good to have you back, and I know you're halfway around the world from us, so it's our evening and your morning, but it's always good to talk to you. And I think there's a lot that we could talk about, but you pay attention to a lot of the metrics and what's happening in multiple economies, if you will. Paint us the big picture. What are you paying attention to, and what should listeners be concerned about in the coming year?
Okay, well, listeners should be very concerned about the possibility that U.S. interest rates will go up during the year. And here's why. The Fed is reversing quantitative easing. So you will recall that once the crisis started, the Fed started creating money, and altogether they created $3.5 trillion. And they used that new money to buy mostly U.S. government bonds and some bonds issued or guaranteed by Fannie Mae and Freddie Mac. And by buying so many bonds, they pushed up the bond prices. And that means they pushed down the bond yields. They pushed down interest rates. And so now interest rates have been hovering around, near record all-time lows. The 10-year government bond yield now is 2.4%. And these lower interest rates have been very important in pushing up the stock market and the property market. But now the Fed is reversing quantitative easing. I call it quantitative tightening. Every month they are, rather than creating money and using it to buy bonds, they're doing the reverse. You could say they are uncreating money and selling bonds in effect. And by doing this, since quantitative easing pushed asset prices, the stock market, property prices quantitative easing pushed the asset prices up, it seems there's a real danger that now that they are doing the reverse, quantitative tightening is going to push asset prices down, push the stock market down, push the property market down, because it's going to push interest rates up. So that's the thing that investors need to be most concerned about this year.
Well, and of course, Richard, for our audience, real estate investors, a big part of what they pay attention to is interest rates for home and commercial property loans. And we've seen a stock market for the last, several quarters that continues to go up in spite of the fact that, we are starting to see this tightening and so forth. But I think folks need to understand it takes a while for these things to manifest. When we first had all that quantitative easing, there were some expectations that we didn't see, but it's because the money didn't necessarily go where it was designed to. In this case, the Fed, by tightening, is trying to shore up the economy a bit, but I think your point is that's going to have an effect that we need to pay attention to.
Right. Well, let me give you a little bit more background information. Interest rates in the U.S. peaked around 1981. At that time, the 10-year government bond yield was 15%. And ever since, the interest rates have been coming down until very recently. And they've been coming down largely because of globalization. Once the U.S. started running very large trade deficits with the rest of the world, and particularly with countries like China, where the wage rates are so low, then this was extremely deflationary. Buying things from countries that produce goods with labor that costs $5 a day, well, of course, that is very deflationary. It pushes down U.S. wages, and it pushes down the consumer price inflation. And as the inflation rate fell, then interest rates could come down. So as interest rates came down from the early 80s until now, credit became increasingly affordable. So the Americans were able to borrow more and spend more. And the level of debt in the United States accelerated very sharply. As a ratio of GDP, in other words, the total debt divided by the size of the economy, it increased from 150% of GDP in 1980. Now it's increased all the way to 370%. So as the Americans could borrow more cheaply, they borrowed more, they spent more. This drove economic growth in the US, and it drove economic growth all around the world. So the danger now is if interest rates do in fact start moving higher, then credit will become, of course, more expensive, and rather than credit expanding and driving the economy, credit will contract and the economy will go into severe recession. So that's one concern about interest rates.
Yep.
And the second concern is more directly related to asset prices and to wealth, because as interest rates came down, property prices went up, and also more recently, since the Fed started printing money and pumping it into the financial markets, the stock market went up. So for instance, just since 2009, the net worth of the Americans, in other words, all the wealth of the Americans minus all of their debt, net worth in the US has increased by $42 trillion since 2009. That's up 75%. Okay, you may be thinking, okay, 2009 was a terrible crash, but it's even $30 trillion above where it was in 2007 at the pre-crisis peak. So this quantitative easing pushed asset prices up to extremely high levels, 75% higher than just in 2009. And so now stock prices in particular are very stretched. If you look at the Robert Shiller's cyclically adjusted PE ratio, which goes back to around 1880, the PE multiple on the stock market has only been higher than it is now two other times. Once was 1929, and the other time was at the time of the NASDAQ bubble in 2000. So asset prices are already very stretched. And that's been possible because interest rates are so low and because the Fed was creating money and pumping it into the economy. So now the danger is that interest rates go higher and we have asset prices crash, credit contracts, it's a double whammy, and the economy goes into severe recession. So that's the biggest concern for investors. Will interest rates go higher? Because if they do, then a lot of bad things are going to begin to happen.
Well, and as you point out, it is a double whammy because not only does your interest, your cost of money go up, but the very asset you're trying to buy or have leveraged is going down. Suppose there's an opportunity to buy a new asset if prices are down, but harder to do that with tighter credit and more expensive credit. So interesting. Now, what about the stock market side of things? There's been this huge run up and it continues to, lure people in, if you will. But a lot of folks have been sounding the alarm bell here. What do you think that the telltale signs are going to be for the stock market having some sort of adjustment?
So I've worked in the financial industry for roughly 30 years now. And I've seen a lot of bubbles here, there, and everywhere. I always say I got my education in bubblenomics in the early 1990s living in Thailand, when Thailand went through an extraordinary boom and bust period in quite a short period of time. The Thai stock market, at the peak, it went up 75% in just the last quarter of 1993. Then, however, it crashed by 95% in dollar terms after that. So the lesson that I believe I've drawn from my experience living through various bubbles is that it's certainly possible to recognize when a stock market is in a bubble. The thing that you cannot know is when the bubble is going to pop. And very often it is the last part of the bubble that is the most exciting, that is the most fun. It's the period when the stock prices suddenly have a dramatic spike up. That may not always be the case, but it has often been the case. And so I believe the U.S. stock market is a bubble now. But should investors sell now? Well, perhaps not. It depends on their risk tolerance. I believe generally the best strategy is just to ride the bubble out to the very top, hopefully surf it all the way to the top. And then once the bubble is fatally wounded, there's usually time to get out before it completely crashes. You won't get out at the exact top, but you may get out at a higher level than if you sell now, for instance. So the way I look at it is, yes, the market's a bubble, but is this the top of the bubble? Probably not. It could surge higher from here. Now, again, the key as to when this bubble is going to pop, much of it is going to depend on interest rates. The most important interest rate in the world is the 10-year U.S. government bond yield, and it's still very low. So even though the Fed has hiked interest rates, I think 5 times now at the federal funds rate level, the short-term level, we haven't seen the 10-year government bond yield go up yet.
Right.
As long as it stays at these very low levels, and if it stays below 3%, that's going to be an environment that should be very supportive for higher stock prices and perhaps higher property prices as well. But if we do start to see the 10-year bond yield move above 3%, go to 3.5%, go to 4%, then I think it's going to be a very different environment. And we are, as I was saying earlier, we are at a tipping point because not only is the Fed hiking the federal funds rate, it's expected to do that at least 3 more times next year, it's also reversing quantitative easing, as I said, through quantitative tightening. But moreover, the central banks in Europe, the European Central Bank and the Bank of Japan, they are still carrying out quantitative easing aggressively. But starting next month, the amount of money that the European Central Bank creates every month is going to drop. In recent months, the European Central Bank has been creating 60 billion euros every month and pumping that into the financial markets. And that's pushed up bond yields in Europe and pushed down interest rates in Europe to very low levels. For instance, in Germany, the 10-year German government bond yield is only 40 basis points, less than half of 1%. And even in countries like Spain and Italy, the 10-year government bond yield is below 2%. In other words, it's lower in these fragile economies, Spain and Italy, than it is in the United States. And so with the interest rates so low in Europe, that keeps pressure on U.S. government bond yields. It keeps pushing down U.S. interest rates. But starting in January, instead of the European Central Bank creating 60 billion euros every month, it's only going to create 30 billion euros every month. Now that's still a lot, but it's a lot less than 60. and they may stop their quantitative easing program altogether in September. So we're moving from a period of extraordinarily unprecedented loose monetary policy all around the world to a period of tightening. And that eventually, if they carry on with it, it will push interest rates higher. And when it does, it's going to very negatively impact the stock market and the property market, I believe. At which point, they will have to stop tightening monetary policy. But the market will first have to sell off before the Fed stops tightening.
Well, and you make a great point that you normally can make some moves as it gets near the top, and even though you might not be able to sell at the very top, obviously, there are some ways to get out quickly, things like the stock market. Real estate moves slower, so you got to be thinking about these things ahead of time, which is why we wanted to have you on the program. One of the things we appreciate about you, Richard, is that you have a world view, right? You live in Thailand, you travel the world, you look at all these various economies. Let's talk for a minute about China. There's a lot of talk and concern and maybe even misinformation about what's going on over there and how that may impact what's happening in the U.S. and in other markets. We have listeners in over 190 countries, so we have folks that are interested in more than just what's happening in the U.S. So what are your views on China at the moment?
Okay, well, China's economy is now probably the greatest economic bubble in the history of the world, but that doesn't mean it's going to implode this year or next year. China's economy has been completely transformed over the last 25 years. They have followed very successfully a strategy based on export-led and investment-driven growth, fueled by credit expansion. But now this strategy has run into a brick wall. The rest of the world can no longer continue absorbing more and more Chinese exports every year. One of the reasons Donald Trump was elected president of the United States was that he promised to declare China a currency manipulator on his first day in office and to impose a 40% tariff on Chinese goods coming into the United States. Well, he hasn't done that yet, but it does illustrate, not only in the US, but around the world, the average citizen has not seen increases in wages for decades because globalization and imports from countries like China have pushed down wages and destroyed the labor unions in the manufacturing industries. And so there is a very strong and growing backlash in the United States and globally against free trade, and particularly against China, because China is by far now the largest exporter in the world, and they still have very cheap labor. So there's a real danger that, first of all, tariffs could go up against Chinese goods, in which case, depending if President Trump really did impose a 40% tariff on Chinese imports into the United States, China's economy would completely implode. But even assuming that something much less radical were to occur, I think we can say safely that it's just not going to be possible for China to continue growing through exporting more and more and more to the rest of the world every year. So the export side is going to stop being a driver. And domestically within China, China already has extraordinary excess capacity across every industry. Cement, for instance, just one example. In just 3 years, 2011, 2012, 2013, in those 3 years alone, China produced as much cement as the United States did during the entire 20th century. If they did that the next 3 years, of course, again, they would be producing in 3 years as much as the US did during the entire 20th century. But that would just represent no growth in the cement industry. It's not just cement, it's steel, every industry you can imagine. China has far too much capacity. The rest of the world is not going to continue absorbing it. And within China, the median income in China is roughly $9 a day. So the Chinese people don't have enough income to purchase the things that Chinese factories are manufacturing. And the rest of the world is not going to continue purchasing them either. Therefore, China is not going to be able to continue growing its economy through investment growth. There's no point in building more and more cement factories and more steel factories when no one overseas or no one domestically can afford to buy the cement capacity that you have already. So not only will they not be able to export their way to prosperity, they won't be able to invest their way to prosperity, And meanwhile, with all of the unsold cement and steel piling up in mountains around the country, steel prices and the price of all the goods being produced by Chinese factories will be weak, and the producers will not be able to earn enough money to repay their bank loans, which have financed this production capacity. And so there'll be an increasing level of non-performing loans in China, ultimately leading to another systemic banking sector crisis in China. So to sum up, China's in serious trouble. Its economic growth model is such that it can no longer generate high rates of economic growth. And this will have repercussions around the world, but I think it is probably unwise to suddenly expect a sudden collapse at this point. It's still possible. The Chinese authorities have a very tight grip on China's economy, and they control the banks, so they can keep the banks lending even if the non-performing loans in the banking sector are piling up. So unless there's a sudden catalyst, for instance, of course, if President Trump did impose a 40% trade tariff on Chinese goods, then the game would end immediately.
Right.
China would spiral into severe crisis with horrible, not only domestic repercussions within China, but horrible geopolitical consequences all around the world. So we'll have to wait and see if that happens. That probably won't happen, but you can never tell.
All right. Well, great information, sobering for sure, but the key is always to pay attention to these things. It's something you do regularly. And before we get you out of here, let's talk a little bit about Macro Watch. You bring great research and videos and occasional podcasts and so forth. How does someone access your work, Richard? Okay, so you mentioned earlier I've written a few books. I have written 3 books, and I hope to write more books going forward. But the problem with books is it takes a year to write one, and then your publisher takes another 6 months before it gets into the bookstores. So what I do now is I publish my work in a video newsletter called Macro Watch. Every couple of weeks, I upload a new video. Essentially, it's me doing a PowerPoint presentation discussing something that I think is important in the global economy and how that's likely to impact the stock market and interest rates, property prices and commodity prices and currencies. So your listeners can find Macro Watch if they visit my website at richardduncaneconomics.com. That's richardduncaneconomics.com. The product is called Macro Watch. If they go to my website and hit the subscribe button, if they use the discount coupon code CASH, they can subscribe at a 50% discount. So I'd like to offer your listeners a 50% discount to Macro Watch. If they go to the website, hit the subscribe button, they will be prompted to put in a coupon code. They should type in CASH, and they can subscribe to Macro Watch at a 50% discount. And with Macro Watch, what I do is I believe that in the 21st century, credit growth drives economic growth, and liquidity determines which way asset prices move. And the government does everything possible to control credit growth and liquidity to make sure that the economy continues to grow. So in Macro Watch, I monitor credit growth, liquidity, and government policy in order to anticipate what's going to happen with the economy and with asset prices. Excellent. Well, that is a gracious offer. We appreciate that. Again, if you just go to richardduncaneconomics.com, a lot of great information that Richard puts up there. And if you click the subscribe button, just enter the code CASH, and Real Estate Guys listeners will get a 50% discount. Thank you for that, and thank you for your great wisdom today, Richard, and we wish you a happy new year.
Thank you very much, Robert, and happy new year to you. I look forward to the next time we have a conversation.
As do I, my friend. There's Richard Duncan, author of The Dollar Crisis, The New Depression, and Corruption Capitalism. Find out more at richardduncaneconomics.com. It's our preview of a new year. What's happening? What should we be paying attention to? We'll have more when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Home Buyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com.
Hi, this is Patrick Donahoe, CEO of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. If you're listening to this, odds are pretty good that you're already a real estate investor, or at least becoming one. So why do you do it? Is it to hedge inflation, the tax benefits, or maybe it's to get your money away from Wall Street? It's because of these benefits and so many more that I created the Real Estate Investor's Guide to the Perpetual Wealth Strategy. When you combine successful real estate investing with the Perpetual Wealth Strategy, you have the recipe for what has helped the wealthy to establish their financial well-being for decades. You can download the Real Estate Investor's Guide to the Perpetual Wealth Strategy today by clicking the Resources tab on the Real Estate Guys Radio homepage. Don't wait, go download it now.
Hi, this is Doug Casey, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station all the time at realestateguysradio.com. We talk real estate every week. This week, we're taking a look forward as the new year is unfolding, a ton going on, and we're super excited to have our next guest making his debut on the program. I must point out he is not a Duncan, however. Please welcome George Ratui, who is the Managing Director of Housing and Commercial Research at the National Association of Realtors. Hey, George, how are you?
I'm well. It's a pleasure to be here, Robert. And you're right. I am certainly not a Duncan.
Well, we appreciate your time today. And, you look at a bunch of different areas when it comes to real estate. Let's first talk about housing, since the National Association of Realtors, the largest trade association in the world, more than 1 million members, you're on the team that's out there looking ahead. And so talk to us, maybe to start, about what you see out there in housing, George.
So housing, especially as we close the books on 2017, with an eye forward, has certainly had an interesting year this past year, in the sense that demand for housing remained fairly solid, but we had another year characterized by extremely tight inventory. And we had hoped that the inventory picture would improve as the year went on. The fact is it didn't. And what we saw in turn was a lot of upward pressure on prices. And towards the latter part of the year, we actually saw sales begin to slip a little bit, particularly September, October. They rebound a little bit in November, December, though the December numbers are actually still coming in, so it won't be till later this month we'll know precisely what the picture looks like. But we saw a slight rebound towards the tail end of the year. So an interesting year. And, of course, in the middle and then towards the end, we had a resolution to the whole tax reform efforts that we've seen through the year. So, obviously, that has added a new chapter going forward into 2018.
Well, that's a good point. There was a lot of speculation, as there always is, and this is, they say, the biggest sweeping change we've had in taxation in the U.S. for a long, long time. Have you had a chance enough to look at it to see, does it benefit folks who decide they want to become homeowners in the new year, or has that changed at all?
Well, the tax reform has made, to your point, some sweeping changes. After all, the last major tax event we had was 1986, so it's been a while. And on the individual side, it has added some changes to obviously both the tax brackets, the marginal tax rates, but also to the mortgage interest deductibilities is capped total amount deductible to $750,000. It's also kept property taxes to $10,000. So there have been already some factors which I think will show up in real estate market going forward. Although I think some of that impact will be felt much more strongly in states where property taxes are significant, like New Jersey, New York, California, where even an average family can face property taxes well past the $10,000 mark per year.
Yeah, absolutely. Of course, the property tax itself is very different as you travel across the country. Of course, we're heard in more than 190 countries here at the Real Estate Guys. So we have folks who are in jurisdictions where there's no tax and jurisdictions where the tax is higher or lower. But certainly people are looking towards the U.S. to see what the change is going to look like, and we can make our best guesses about that, but appreciate your insight on that. What else are you looking at when it comes to single-family, the single-family market and demand and millennials and, new housing starts and anything you can share there?
Absolutely. And I think that one of the important things to consider when looking at the housing market is on the demand side. We are looking at a market which is still experiencing rising demand. And when I say that, I look much more broadly. So I look at the demographics of the United States. And to me, the one strong positive about that is we're looking at a country which for the last decade has grown almost 9%. So we have a little over 30 million people in the country. And to me, why is that significant is generally a country with no population growth has a very hard time having a growing economy. So the fact that the U.S. has grown significantly over the past decade is positive because it shows up in the economic momentum, which obviously is going to drive demand for housing. In addition, what's also significant is this population growth has also pushed our country into a new era where we have a lot more younger people in the economy. The much talked about millennials, which I think sometimes is maybe an overgeneralization. However, it's worth noting that there have been some concerns over the last few years that this generation is very different than the generations before it, and that's likely to have a much stronger impact with themes like, well, millennials don't want to buy homes, millennials don't want to buy cars, they are into the sharing economy, they're just going to rent everything from apartments to vehicles as needed to desks. Well, the truth is, when we're looking at actual the data, what we're seeing is basically a generation that is exhibiting the same similar signs at various stages of life. And those seem to be a lot more important. What I mean by that, millennials have entered the workforce over the last decade or so, but they were at the stage of life when they were mostly single, young, very few commitments. They're looking, obviously, at starting their careers. Now that the oldest millennials have started having families, having children, what we're seeing is that they very much are similar in that regard to older generations. They want to buy homes. In addition, they have started buying vehicles. And interestingly, on the recent data on auto sales, it turns out that the most popular vehicles for the younger buyers, the millennial generation, tend to be SUVs and crossovers. Something that was, again, much feared that they stopped buying. The truth is, obviously, when they're faced with the prospect of children or looking at schools, it's one of those stage of life issues that is obviously driving a lot of this. So I think that is significant, and I think it's good news in general for housing, where they're obviously hitting a bump in the road. A lot of the younger folks, especially first-time buyers, is looking at affordability. As I mentioned earlier, with very tight inventories, prices have been going up. In fact, they've been going up over 6% year over year for the past 2 or 3 years. And when you put that in against the fact that wages have only gone up about 2% adjusted for inflation, obviously that puts tremendous pressure on a family's budget. In addition, mortgage rates, even though they're still near historic lows, have been climbing a bit this past year. So that simply adds to that affordability challenge for a lot of these young buyers. And that's before we even get into the discussion about student debt, which presents a serious issue for the millennial group and hampers some of their ability to actually make a significant commitment to borrow for a house.
All excellent points. And, one of the things as real estate investors is we are all for a positive economy, But if it gets too good and too affordable, then a lot of folks that could be tenants become home buyers. And of course, realtors very much are out there to help home buyers and sellers, but also in the investment space. And so it's interesting to consider these things. Now, I also know, George, you spend a good deal of your time on the commercial side, and I want to talk a bit about that. In fact, you produce the Commercial Real Estate Outlook quarterly for NAR. What's the big picture on the commercial real estate side for the new year?
So commercial real estate has had a very interesting run since the 2008-09 recession. It obviously, along with all the other economic sectors, took a pretty serious hit. The volume in the space declined tremendously, but at the same time, the rebound was actually much quicker. So in big cities particularly, so what generally gets termed as large cap commercial real estate market space, where deal transactions tend to be aggregated at $2.5 million and above, that recovery started in 2010, and it started quite swiftly. In fact, it preceded by a little bit the recovery in residential markets. And those markets recovered quite well, were in fact galloping at double-digit pace for a few years as investors returned to the market and price appreciation and valuation ensued. And by 2016, valuation for commercial assets had exceeded their prior peaks from 2007. 2017, what we saw was basically a decline in volume at the higher end as a lot of investors took a step off the accelerator and started looking more cautiously at the value of properties. Prices, however, remained on an upward trend, but investors have obviously taken a more disciplined, cautious approach. At the small cap space, so deals under $2.5 million, in a lot of the markets which traditionally were referred to secondary or tertiary markets, that picture looked quite a bit different. In fact, we had a continued acceleration in deal volume during 2017. As, interestingly, investors realized that there was a lot of potential in smaller markets. And by smaller markets, I mean Austin, Texas, Nashville, Tennessee, Jacksonville, Florida, markets where local economic conditions have gotten quite strong, with a lot of population inflow, job growth. So interestingly enough, the trend not only got the attention of domestic investors, but global investors started branching out from the big cities. Traditionally, foreign investors, whether they were individual or institutional, tended to gravitate towards New York City, San Francisco, Chicago, Washington, LA. In this cycle, however, they really found much more solid returns in addition to stability in some of these smaller markets. So that, I think, has helped boost a lot the appeal of these properties as well as their performance. So looking forward to 2018, I would say that the big theme for the year for commercial real estate would be sort of a stable platform for investors. Probably price appreciation will flatten out for the year. Some markets even see some price declines. However, that only underscores the fact that the assets themselves continue to be attractive, and for pretty good reasons. The U.S. economy in general has performed quite well during this cycle, even as economies in Europe and Asia have had to have much longer quantitative easing. So monetary policies in parts, some central banks in Europe, Bank of Japan, resorted to negative interest rates. So a lot of those investors were looking for better returns, and the U.S. provided that, and I think 2018 we'll see a continuation of that trend.
All right. Well, great stuff and excellent job of hitting the high notes. We could probably go on for another hour, but we're very appreciative of your time today, George. George is the Managing Director of Housing and Commercial Research at NAR, and great stuff today. Thanks so much for being on the program.
Thank you so much, Robert. A pleasure.
Well, there you have it, our predictions panel 2018. 2 full weeks of amazing folks with great ideas. I don't know about you, Russ, but my head is spinning.
Well, I think the important thing for all real estate investors, any investors or anybody that's interested in any topic, is just to make sure that they're paying attention. And there's so many things to pay attention to. So the shortcut is to network with a bunch of other people that are paying attention and listen to what they have to say and how they're processing. You know, as you hear, not everybody always sees things the same way or agrees, but that's okay. That's not what you're not looking for consensus. You're just looking for perspectives. You ultimately have to make up your own mind because at the end of the day, it's your money.
Yeah, huge point. And the fact that everybody has an opinion. These are opinions, educated opinions, storied opinions, but at the same time, no crystal balls. So hopefully you got some good ideas, maybe some ideas on things you need to research and pay attention to. Huge thanks to housing researcher and building consultant John Burns, the CEO of U.S. Global Investors Frank Holmes, former Fed insider, broadcaster, and author Danielle DiMartino Booth, scientist, energy expert, and author Chris Martenson, Fannie Mae's chief economist and senior vice president Doug Duncan, noted economist and best-selling author Richard Duncan, and the National Association of Realtors managing director of housing and commercial research George Ratui. What an amazing show. Couple of shows, actually. And Real Estate Trivia will resume next week. And also on the program next week, we'll be talking about making the jump from single-family to multi-family investments. Until then, go out and make some equity happen.
Hello, this is Robert Kiyosaki, and I'm very excited that I'll be joining the real estate guys for their Investor Real Estate Summit at Sea. Join me, join my friends, join the Real Estate Guys Investor Summit at Sea, and I'll see you out there. Thank you very much.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.